Alright, thanks for coming to the channel. Thanks for coming to this video. Today we're going to talk about the different kinds of life insurance, what they do, what they're for. So let's start it off. We've got accidental, right? We've got term. We've got whole life, right? Those are the three broad categories. We have IUL, or indexed universal life, right? And then we've got final expense. We've got a few others that aren't talked about very often, but we've got single premium. Whole life. Right? Single premium whole life. Yeah. So, accidental, term, whole life, IUL, indexed universal life, final expense, single premium life. We've also got so there's those. So now we're going to cover each one and where they fall, right? So of those types of insurance, we break them down further into permanent. Well, I can't write today. And temporary short term, right? So under permanent, that's going to be where your whole life goes. Your IUL, right? Final expense. Single premium. Now that would be. So what makes these permanent? These are permanent because, right, they build a cash value. Right, to build a cash value. Whole life and final expense, premiums, are locked in, right? Designed to go to age 120. So to age 120 or 121. So they're sold as permanent, being you can't outlive them. You might be able to outlive them. And so you ask what would happen then. So if you happen to live to age 120 and your policy is still in force, the insurance company is going to mail you a check for the proceeds of your policy because the contract has matured and you've outlived the policy. So then you get the money. Right? So build the cash value, permanent, premiums locked in, to age 120. Can't be canceled. As long as you're paying the premiums. IUL is a special case. We'll cover that here in a little bit, right? But basically, permanent insurance, built to cash value, premiums are locked in, designed to go to age 120 or 121, depending on the company, and can't be canceled, right? All very good things. Now, over here on the temporary side, right, we've got term. And under term, we have return of premium, level term, right? Yeah. Level term. Yeah. Annual renewing term. And then we have accidental. Right? Yes. So term accidental. So return of premium level term. What that does is at the end of whatever specified period, all the percentage of the premium that you've contributed to the plan gets refunded to you at the end of the term. There's some plans out there that do 50% return of premium, some that do 75% return of premium, some that do 100% return of premium. So if you're young, you need a plan, but you know you're not going to need it at retirement, but you'd like to have the protection while your family's young, and you want to save for retirement, it's a good way to get both. Level term. Level term is just what it says. It's going to be level for a specific period of time, and then it'll increase in price. Annual renewing term. Annual renewing term sounds like it, just what it says. It goes up every year, so it's annually renewing. So it goes up and up and up. Right? Accidental. Accidental is very cheap, but it only pays when you die from an accident. Right.